Now, capital appreciation, is it the acronym here, CTA?
Well, I think they normally call themselves Capital Appreciation, the full name.
So is a special purpose acquisition company which has recently acquired fintech sector assets. It's a market cap 1.2 billion rand here, PE of 24.5, no dividends.
It's been around for a while, and the people involved with it most visibly is a guy called Marty Sachs, who's an old corporate player. He was the one of the early CEOs of Netcare. His son, Michael, is involved, and there are various other people, the government employees pension fund and the likes. But as you announced, they're fintech assets. So for a while it looked like they were going to go healthcare, and now it looks as though financial services technology is where they're at.
One can
So
add
give us
Maya
the
Khan
rundown
as well.
here.
Another individual that's well known.
Ex-SAB,
SAB,
Miller,
exactly. And these two
CEO.
individuals were also part of Afrocentric, you might remember, with our Med scheme coming into that. So,
And just a comment on the branding, there's nothing like calling it actually what it is. So you
What
wanting
they
to
hope to
appreciate
do,
your
yes.
capital, let's hope that they fulfill their mandate in terms of their brand.
They appreciate it, they've got respect for it, and they hope that it will appreciate in future. And there's once again a fee structure in this capital appreciation. So if they do appreciate the capital, there's a base fee and a performance fee, which is fair. I mean, I come from the hedge fund industry, so I can't criticize it too much. But I do think that they do have a permanent capital vehicle. And having these kinds of fee structures on a permanent capital vehicle is a bit more questionable, because you can never really extract your capital if you're not happy. With a hedge fund, you can always take your capital out if you don't like the
That
performance
liquidity
anymore.
element is incredibly important.
Correct. Well, here you're in a secondary market where if the market prices it at a discount, you won't get full value from your capital.
Look, that issue is already on the table. There have already been some ructions here. So they've done a couple of deals. They've bought two companies, one called Synthesis and another one called African Resonance. Not not Renaissance, Resonance.
Are you sure about that?
Now, what these companies do are they're sort of financial integration, fintech companies that work with banks and other financial players. I'm not all that sure. But the details, they're pretty hefty transactions, 485 million here, 300 million there. And in doing the deal, the management team at Capital Appreciation have already allocated themselves a big new chunk of shares, which it turns out was in the fine print of the listing arrangement, that if they placed a big deal, they could indeed issue themselves more shares. So
But
there's
just
a big
the way that
dilutory.
you say that, fine print, it means that there's no.
Well, nobody
little
reads these
unhappiness.
things,
Exactly.
and then when it
suddenly
happens,
there's a
they're
huge
like,
chunk of
"What?"
shares allocated to management.
Yeah.
The fine print took you by surprise?
No, because I read the pre-listing statement.
I would expect you to
that
read
is-
the fine print.
If you think about what companies issue, and you think specifically about press releases, all the flowery news and language and all the good news, the pre-listing statement is one of the best sources of information you can go for any company when they list. Because for regulatory requirements, they need to say it as it is in those documents. So yes, there's a lot of fine print. Thank goodness on a PDF on your computer, you can always do Control F, find certain keywords and go through all that detail. But in the detail, this incentive structure was there. But I agree with Paul. It's questionable. It's quite lucrative for the managers involved. For the investors in the company, not so much yet. We wait to see.
Anything else you want to add before we call
There's
it?
another deal in there where they bought a business called DashPay, which is in startup, but it sounds quite attractive because it's quite similar to Square in the US, where it's like a single point of sale, card acquisition, payment solutions type of businesses. So I think it's going to be interesting to see how they roll this out. And I'm also interested to see, once they do a deal, what the next set of results look like, because then we'll be able to see just how much cash flow there is, what kind of valuations we're being asked to suck up on account also of all the additional shares that the management have placed in there.
JP, I have a
interesting
feeling
thing.
you may call this not hot.
Your feeling might be correct, Bronwyn. I think given the incentive structure, we don't have a long-term track record of the businesses they've bought, quite chunky businesses in the fintech space, which is very exciting, but also conducive to a lot of redundancy. I've got my
Not hot.
my
Paul,
not
you're
hot
going to
hat
follow
on.
JP
I'm
on
going to be a
this.
little bit more brave because I like the team and I do see Marty from time to time in passing. So I'm
And you
going
wouldn't like to call an associated company
Yeah,
to
and the
Marty
fintech area is
not hot.
attractive, and we know we've got big established banks and other financial players that are looking for this kind of support. So I'm going to give it a provisional hot, but with one eye closed.
I've never had to evaluate
That's
that
you.
kind of description before. Then give me some time and I'll unpack it.